Hello and welcome everybody. My name is Sebastian and today we're going to be solving question 3 from the fall 2011 midterm for COMM 217. This problem focuses specifically on accounting for receivables and bad debts expense, and it's a two-part question. So we have part A, part B. So let's get ahead and let's start with part B. I'm just going to zoom in a little bit so we can better read the question. So starting with part A, the December 31st, 2012 statement of finance position of House Unlimited reported trade accounts receivable of $450,000 and a credit balance in allowance for doubtful accounts of $45,000. During 2013, the following transactions occurred. So we have our first transaction, service revenue billed on account for $1,500,000. 2, collections from customers of $1,300,000. 3, accounts written off as uncollectible. So these are accounts that the company is assuming or they're expecting not to receive. And 4, collection of accounts previously written off of $4,000. So these are accounts that the company said were not getting paid, and then they did end up getting paid later on during the year. Next, we'll move on to our required. We'll read through these, and then we'll get started. So number 1, we're being asked to record the 2013 transactions in journal entry form. 2, the company uses the aging of receivables method to estimate bad debt expense and determined that uncollectible accounts are expected to be 5% of the balance of trade accounts receivable. They would like this to show the adjusting journal entry at December 31st, 2013. And finally, they would like this to show in proper form how trade accounts receivable would be presented on the company's comparative statement of finance position as at December 31st, 2013. So it's not too bad. We have some decent information, and we'll get started with the first required. So, required number 1, record the 2013 transactions in journal entry form, and for this we'll be looking at our information right here. So we're going to move on to a blank page and get started. So here we see that we're answering question 3, part A, required 1. So we're being asked to solve or to record journal entries. So we'll get started with the first journal entry. So in the problem, moving back, we saw that the first one was service revenue billed on account for $1.5 million. So throughout the year, $1.5 million worth of work was done for other individuals, but some of it was done on credit and is yet to be paid. So we'll have to record that. So we see that their trade receivables, and I'll use TR to shorten my handwriting, was $1,500,000. So this is work that has been done, but payment is still being waited for. And we provided services and received revenue, so we would like to record our service revenue of, again, $1,500,000. Next up, we have B. So we're going to take a look at what the second journal entry was. So we see that we have collections from customers of $1.3 million. And we're going to assume that all of it is collected in cash. So if we move back here, we see that we've collected cash of $1,300,000. And this has been collected from our previous trade receivables. So if we look at a T account, for example, of our trade receivables, we see that we started the year with $450,000, and throughout the year we collected $1.5 million. But out of this, we've now taken $1.3 million that has been collected as cash. And we'll keep this T account here for further information because it will be useful for other requirements. So finishing up the transaction, what we've just seen and done in our T account is that we've taken away $1.3 million of what we were expecting to collect. So that is our second journal entry. Now we move on to our third. So in our third, we see that accounts written off as uncollectible for $37,000. So this means that the company is assuming $37,000 won't be collected. And I really like to use T accounts, and they're very helpful when we're dealing with allowance for doubtful accounts, which I'll call AFDA. So we were told at the beginning of the problem that our beginning balance in the allowance for doubtful accounts was a credit balance of $45,000. So let's put that in there. And now we're being told, just 2 seconds, that we have written off as uncollectible $37,000. So this means that we're providing a debit, we're debiting accounts right here for $37,000 that we don't think we'll be able to collect. So if you look at our journal entry, we have allowance for doubtful accounts, AFTA, for $37,000. And this is being taken out of trade receivables that we were expecting to receive, but we most likely won't be anymore, or we don't think we will. So that is our third journal entry, and we move on to our fourth journal entry. So looking at our fourth journal entry, we see here that we collected accounts previously written off for $4,000. So we thought we wouldn't collect it, but mysteriously they came back. So let's see how we would journalize that. So first of all, we have to reverse our previous entry. So we thought we wouldn't collect it, we added it, we took it in AFTA, and we took it in trade receivables. So we want to reverse that and bring it back in trade receivables and back to AFTA. However, it wasn't the full $37,000, it was just $4,000. And moving to our T account, we can bring this back over here, and we see that $4,000 has been re-brought back. But that's not all. Not only did we receive it back, but we received it in cash. So what we have to do is take it out, because it was received in cash, and it's no longer in trade receivables, so it has been collected. So these are our 4 journal entries, and that is requirement 1. All right, so now that requirement number 1 is over, we're going to go back and take a look at requirement number 2. So let's get started. Zoom in a little bit, and here we are. So we see the company uses the aging of receivables method to estimate bad debt expense and determined that uncollectible accounts are expected to be 5% of the balance of trade account receivables. Showed the adjusting journal entry at December 31st, 2013. So what they're telling us here is that their uncollectible accounts are calculated using 5% of the balance of trade accounts receivable at the end of the year. So our first step is to find that balance at the end of the year, and then taking 5% of that, we can see what our allowance for doubtful accounts should be. So I'm going to scroll down for a bit here and zoom in so we can get started on requirement 2. So requirement 2, we said we're looking for 5% of the end balance of trade receivables, and I'm just going to do this to separate our previous requirements. So the ending balance of trade receivables. How we can find this? Well, we've actually done most of the work. If we scroll up here, we see our trade receivables and basically what we've accounted for here. So I'll just recopy that down here for requirement 2. So we have our trade receivables. We started with 450,000, and then we sold throughout the year 1.5 million. Then we collected in cash 1.3 million. And finally, we wrote off certain accounts in the previous problem worth $37,000. So what we can do here is do our total, and this brings us to $613,000, which is our ending balance at December 31st, 2013. So using this number here, we were told that 5% of that times 5% is our expected uncollectible accounts. So this multiplication gives us $30,650. And what this means is that this is the amount that we would like in our allowance for doubtful accounts at the end of the year. So we have to find the difference of where it is now and how to get to that amount. So scrolling up, we see that we've actually already done most of the work here. So just like we did with trade receivables, I'll recopy the table and we'll get to work. So we saw that in our allowance for doubtful accounts, we started with $45,000 and we wrote off $37,000, but ended up collecting $4,000 back. And at the end of the year, what we want is $30,650. However, if we do our problem here, 45,000 plus 4,000 minus 37,000, we see that our balance right now is equal to $12,000. However, we have $12,000 and we really want to get to 30,650. So what we have to find out is how much we're missing. So we have 30,650. We're currently at only 12,000, which means that we're missing $18,650 to be able to reach the right balance in our allowance for doubtful accounts account, if that makes sense. So now that we know what this balance is, we're going to try and turn that into a journal entry. And I'm running out of space, so we're just going to move on to the next page. So this is requirement 2 continued. So we know that our AFTA is missing $18,650 in a credit balance, as can be seen on our T account in the previous page. So what we need to do is have a bad debt expense, so an expense for what we expect not to collect of $18,650. This is credited to our AFTA account for $18,650. And if we finally recreate our allowance for doubtful accounts to make sure we've done everything right, we'll be able to see if everything balances. So we started with 45,000, wrote off $37,000, recollected $4,000, and as we just saw, added another $18,650 to be able to reach our $30,650. And we do see that this calculation does equal to this. So that's a check mark. And this amount is what was received from the 5% right over here of our net accounts receivable at the end of the year, 5%. So that's requirement 2, and we'll now move on to requirement 3. So let's get started with requirement 3. Let's zoom in a little bit. All right. So requirement 3 asks us to show in proper form how trade accounts receivable would be presented on the company's comparative statement of finance position as at December 31st, 2013. So again, what's important here is that we really want to show in proper form comparative statements. So let's get started with that. So first of all, we want to make sure, 2 seconds, there we go. We want to make sure that we have proper form. So this means that we have all the important information for a statement of financial position. So we would start with the company's name, Hassan Limited. We would explain what statement this is. So it's not a full statement of financial position, it's only partial. Statement of financial position, long-winded. And we want to specify at what date. So it's as at December 31st. Secondly, we want to classify properly. So since we're talking about cash and trade receivable, we do have current assets. And that's current, not current. There we go. And they asked us for comparative statements. So they want us to compare and be able to see how the accounts have differed over the years. So we're at the end of 2013, and we're going to be comparing to 2012. So we can skip cash and everything else because we don't necessarily have that information, but we'll go straight into trades receivable. So at the end of 2013 and at the end of 2012, we got to find out how much we had. So going back to the initial problem, there we go, we were told that at the beginning of the year, and we'll highlight that in a different color, there we go, the beginning balance for 2012 was $450,000. So that's a given. And if we move over to the work that we did for the second problem, right over here, we see that at the end of the year, we had ending trade receivables of $613,000. So using both of these figures, we can fill in the information we need right here. Next up, we want to take away our allowance for doubtful accounts, because on our statement of financial position, we want to show the net realizable value of our current trade receivables. So much like the last step, these two amounts have been given and have also been calculated. So for 2013, we've calculated this amount right here, $30,650, and for 2012, it was a given value right here of $45,000. So those are very simple. We knew where they were, and we can plug them right in. $30,650 and $45,000. And what this gives us is the net realizable value of our trade receivables. Doing this simple calculation, we get $582,350 and $405,000. And that's it for requirement 3. All right, so now that we've finished requirement 3 in part A, we're going to go back and take a look at part B of the question. So zooming in a little bit. There's a lot of text, so we'll walk through it slowly. All right,